In this video, I'll be giving you guys a 5-step mechanical trading strategy that I use every single day and has gotten me and all my mates funded accounts. This strategy is painfully simple, and if you implement each of these steps in order, I can almost guarantee you that you increase your win rate and it helps you push you over that lip towards profitability. Okay, so getting straight into it, the first step in the mechanical trading strategy is market structure. Okay, so there's 3 different types of market structure. The first one is bullish, where we're making higher highs and higher lows. The second one is bearish, where we're making lower lows and lower highs. And then the third one is where the market isn't going up or down and it's just consolidating. Now remember, we do not want to be trading a consolidating market. If market's moving side to side and doesn't have a clear direction, we do not want to trade that pair and we want to stay away from that pair. Now for the bullish and bearish market structure, we want to be trading these impulses. Boom, and then these impulses over here. Now you can trade these pullbacks. However, the downside to trading these pullbacks is most of the time you won't get a good enough risk to reward ratio for this to be a trade that you want to take. And you also can't predict how far the market is going to retrace within that impulsive leg. Because sure, you could see some liquidity in this impulsive leg up and you can target it, but the chances that it gets to the liquidity that you've targeted, it's just a guess. So although it's possible to trade these retracements, the best trade and the A+ setups is going to be when you're trading these impulses. Now, after you identify the first step, which is market structure, you then want to move on to the second step, which is supply and demand. Let's take this as an example. So thinking of step 1, market structure, the red line is the overall swing of this trade, okay? So what can we see? If we look back, we are obviously in an uptrend. Number 1, we're making higher highs right over here, higher low, and then here's a higher high right over here. So we're in an uptrend and we are bullish. Now this is where it gets complicated because obviously your charts aren't going to look like this. It's not just going to be straight lines. They're going to have bumps in it like this. Boom, boom, boom. You know, market goes up, down, up, down, up, down. It's just how it is. Now, once we identify market structure, which is uptrend, we basically need to know when the market is reversing so we can catch that next impulse phase up towards the upside. And how do we do that? Is by supply and demand. Now, before I get into this example, what is supply and what is demand? So in an uptrend, we're looking for demand, and in a downtrend, we're looking for supply. Now, what demand is all these little bumps in the road. This is demand, this is demand, and this is demand. So all these little bumps in the road. Notice how once the impulse phase happens, market retraces into one of these bumps in the road, so it goes back into demand before it has its next impulsive move back towards the upside. Same thing with the downtrend. This retracement, that is supply. This retracement, that is also supply. So once market has an impulsive phase, it then retraces back into the bump in the road, so the supply zone, or you can also say it retraces back to the previous, where the previous retracement started, and then it has its next impulsive move down towards the downside. So what do we know? We know that the price is obviously in an uptrend because it's overall swing up. It has its retracement, and then there's another impulsive swing towards the upside. So expecting it to come back into this retracement and then have its next impulse up. Okay, so based on what I showed you here, you would think, okay, so it's just the entire retracement before the impulse up. So then in that case, wouldn't it be this entire zone? And the answer is yes, this entire zone is considered a demand zone. However, taking a trade on this demand zone like this would not be very smart. You wouldn't be getting that good of a risk to reward ratio. You'd be in the negatives. But that's why you have to refine your zone. Now remember all these bumps I showed you? All of these bumps are just demand zones on a lower time frame. Now over here, demand zone failed, and that's when we went into a downtrend, and that's when supply took control. Now, how do we know which demand zone we expect that impulsive phase to happen from? And that is from looking for a demand zone that's unmitigated. And what unmitigated means is it has not been touched. So if we look here, this demand zone, so this last push down before this push up that has not been mitigated, is all the way down here. So if we draw this out, we can see that Price came in and then we had a change of character back towards the upside. Now, once you've identified the second step, which is your refined area of either supply or demand, and in this case is demand because we're in an uptrend, we then want to move on to the third step, which is premium versus discount. Premium versus discount is just above or below 50% of the impulsive move. And you can identify the 50% level of the impulse using the Fibonacci retracement tool. Now, I want you to copy these settings on my Fibonacci retracement tool. Boom, copy these settings. I put it as white, but you can choose any color that you want. Now, on this Fibonacci retracement tool, you want to look at this number right over here, the 0.5, which is 50% level. So what you want to do is you want to take your Fibonacci retracement tool. You want to draw it from the bottom of your impulse to the top of your impulse. And then what you want to do is you want to look at the 0.5 level and make sure that that refined area of demand that you had drawn on is below the 0.5 level. Now it's the same thing for a downtrend, but you want to take your Fibonacci retracement tool from the top of that impulse down to the bottom of that impulse, and you want to make sure that that supply zone that you drew is above the 0.5 retracement area. Now, why is that? Let's say that this is the impulse. Above the 0.5 is what we call premium, and below the 0.5 is what we call discount. Now, in an uptrend, when we're bullish, why do we want price to be in a discount? Now, the reason is, pretend in real life you go to a store to buy something. Would you want to buy it at its most expensive price or at its lowest price? Of course, you want to buy it when it's at a discount, when it's at its lowest price. And then same thing with a downtrend. Above the 0.5, remember, is premium. Below the 0.5 is discount. When you're selling something, you want to sell it at its premium value. You want to make the most amount of money. So you'd wait for price to go into premium value before you want to sell it. And same thing if you're bullish, you want to wait for price to come back into discount value before you buy. So going back to this example, you want to make sure that your refined area of demand is below the 0.5 in what we call discounted price. Now, let's say step one, you've identified market structure. You've identified whether you're bearish or bullish. Step two, you've identified a refined area of supply or demand. Step three, you've ensured that your area of demand is within discounted price or your area of supply is within premium price. Now, step four is liquidity. Now, remember when I taught you about a zone being mitigated? This is when liquidity comes into play. So notice how this refined area of demand is unmitigated. So it has not been touched. And above this unmitigated zone of demand, there is a bunch of mitigated demand zones. Now, what liquidity is basically, in easy terms, is just a bunch of stop losses. Now, a bunch of retail traders don't understand that they need to look for a zone that has not been touched. So what retail traders will do is see this zone over here. They'll be like, oh, it's a demand zone, not understanding that it's already been touched and is basically an invalid demand zone. Now, what they would do then is they would place their entry on top of this supply demand zone with their stop loss below this zone, targeting a new higher high. Now, right below this is a demand zone that is unmitigated, so it has not been touched. So all these stop losses that are right above this unmitigated and valid demand zone acts as liquidity. Now, once you've ensured that there is liquidity above your demand zone or liquidity below your supply zone, if you're bearish, you want to move on to the fifth and final step, and that is to wait for a change of character, also known as a chock. So over here, step one, we see that market structure is bullish. Step two, we have our refined area of demand. Step three, we draw on our Fibonacci retracement tool and we ensure that this area of demand is below the 0.5 level. We then identify that there's liquidity above the demand zone. And then once price does enter this demand zone, what do we see? We see a change of character. Internal price action is bearish. Price comes into this area of demand, breaks above the previous lower high, and I must say break and closure above the previous lower high, which then signals to us that the market is now ready to make that new impulse higher. And when I said break and close, this is what I mean. Notice how price has come above this line. However, the body candle, so the actual body of the candle, has not closed above the lower high. It's just wicked it. what you want to see is that the entire candle closes and the body closes above the high. Now, this is the fun part. This is when all 5 confluences have been met. You can now enter the trade. Now, what you do is you take this entire move down before this change of character and use it as a new area of demand. Now, what you want to do is you want to go down to a lower time frame. And when you go down to a lower time frame, this impulse that you see over here will be full of a bunch of move ups, move downs, just like this. And then what you want to do then is find another zone that's unmitigated. Like we did over here, find a zone that has not been tapped into. Now, what I've done is I've just taken this highlighted impulse and put it down here to represent a lower time frame. Now, again, what you want to do is you want to find that unmitigated area of demand on that lower time frame. And that is where you'll be placing your entry. Like this. Now, where do I put my stop loss and where do I put my take profit? Let's say this zone that I've just drawn out is that unmitigated area of a lower time frame demand zone, but back on towards the higher time frame. You take your entry on top of that zone with your stop loss below the original demand zone. And what you want to do is you want to target not past, but just up to that new high. And then what you then see happen is price will then move down, tap you into your position, and then move back up towards the upside, creating that new impulse up. So there you go, a quick review. So number 1, market structure. Number 2, supply and demand. Number 3, premium versus discount. Number 4, liquidity. And number 5, change of character. These 5 steps, these 5 confluences, whatever you call it, that's all you need. Now, if this is all confusing, which I understand it's a lot, it's very confusing, I have a free Discord. You can check out the link in the description down below. Click on that. It'll take you to my free Discord link. You can ask away all your questions. Either me or someone within the Discord will answer your questions for you. Now, if you really want to fast track your trading journey, I have a one-on-one coaching program where I take you on a trading and a complete tailored self-improvement program as well, because I am a firm believer that your life off the charts will present itself on the charts. So if that sounds interesting, click the first link in the description down below. You fill out a form. We basically hop on a call with each other, see if we're a good fit for each other, and we go from there. But other than that, if you have any questions, drop it in the comments, or you can join my Discord, or you can DM me, whichever one floats your boat. And I really hope that you guys got some value out of this video.